Alrighty, hello. I feel like this is so intimate that, we could actually lose the mics and actually have a normal conversation over here. And my name is Saqr Ereiqat. I'll have the pleasure to be your host for the session today for something that everyone is thinking about today. The promise of blockchain way back when the Satoshi white paper was launched, was to build a parallel and alternative financial services infrastructure. Now, looking at this 15 years onwards, we're slowly but surely coming to the plateau of productivity. And on stage today, we have people that are driving this change from the front. We have three infrastructure providers, each one of them looking at this from a different lens, from a different point of view. We have layer ones that were targeted towards developers. We have layer ones that were originally targeted for large institutions. And of course, we have a local player that is making this a reality today. My name is Saqr Ereiqat. I'm the Secretary General of the Dubai Digital Asset Association, and it'll be my pleasure to walk you through this today. Ladies first, why don't we start with a quick round of 30 seconds introductions, please.
All right. Thanks for having me today. My name is Sabrina. I'm with the Hedera Foundation, and I do ecosystem development, specifically in the fintech and payments space. So I can provide the layer one protocol, the view from like the base layer, because we are a layer that supports stablecoin issuance, as well as RWA tokenization and all sorts of things. I am based in Singapore, so I've seen a lot of I would say a lot of traffic between the two regions. So I'm happy to also to chime in on here versus there.
Wonderful, thank you so much. Aishwary, why don't you bring your seat a little bit so we can actually have a conversation, so we can see each other. You're good. All right, wonderful. Okay, I love redecorating. So Jonathan, over to you.
Yeah, hi everyone. Jonathan Rigg. I work for Fuze. We're a local UAE born and bred local fintech, regulated digital asset infrastructure, providing trading and payment services to institutional investors, banks, brokers, fintechs, PSPs, and local corporates. So I can definitely speak around the local adoption, regulation, and use cases that we're seeing as the proliferation and adoption of stablecoin real-world use cases has almost been at the forefront with the Middle East of the supportive local regulation and a lot of the adoption we're seeing. So,
wonderful, great to have you here, Jonathan. Aishwary.
Yeah, hi everyone. Aishwary this side. I lead the business globally for Polygon, and I think Polygon is like a layer 2 blockchain, which has been right now like fully focused towards payments and tokenization. So a lot of if you look at all the big names of fintech, a lot of them are actually using Polygon, from the likes of Revolut, Robinhood, Grab, Geo. So a lot of those, there's a lot of banking movement of funds that is actually started happening on the blockchain itself. So that is where we have been very focused towards bringing more regional stable coins on the blockchain itself, and then growing a lot of those fintechs across, building an international network, where you can actually just go out and be on the network and be able to access that money across the world.
Nice. So I didn't promise too much. These guys are uniquely positioned to provide you a great point of view. But before we start, who's ever paid something in the real world with crypto? All right, okay. So at an investment and crypto conference, it's still only 4 and 5 people. Sabrina, I'd love for you to help us set the stage. What is this industry looking like today? What is the reality? What is the hype? Where are corporations going, particularly?
That's a good question, right? Because I think when it comes to stablecoin adoption, if you kind of look back historically, the first stablecoins were launched to facilitate trading, going in and out of other cryptocurrencies. You would park your assets into, you would have pairs against, USDT was one of the first ones. And for the first few years, it was the main use case for stablecoins. that's changing. You know, of course, this with trading, there's been more retail adoption, and then people started kind of using it informally for remittance and such. Still clunky because there's not a lot of infrastructure around it. But we're seeing, I think, the past couple years, like really, we've hit that, you know, that hockey stick, that acceleration, where stablecoins are being used more and more for cross-border payments. A lot of it B2B. Corporations are, I would say, large, you know, multinationals are getting more and more interested in adopting. So there's a study by EY Parthenon that came out earlier this year that looked at, you know, adoption among a group of financial institutions and corporates. They found about 8% of corporates actually beginning to have used stable coins, about 23% of financial institutions. Of those 8% of corporates that have used stable coins, I think 90%, 91% reported that they are saving more than 10% of cost of treasury operations. So clearly, there's this 5-10%, but clearly there is an impact on the bottom line on even large corporations, because they were mostly large corporations that were part of the survey. While you would expect large corporations should have had a good level of optimization of their cross-border flows, but even then, they saw a measurable impact. But what's also more interesting is out of the ones that are not using stable coins yet, maybe half or so are expecting to use stable coins within like 6 to 12 months. So there is really a high level of awareness and intent among corporates. And at Hedera, we see that firsthand because we are a permissioned blockchain, and the nodes and the governance is done by a group of 30 plus very large companies, mostly Fortune 500s, you know, Google, IBM, and such.
Tell us a little bit more, because I think it's a unique concept that no one's yet tried to replicate. So you have IBM, you have Google, who else?
So we have financial institutions, for example. Not that one, but we have two. We have banks like Nomura, Standard Bank, Shinhan Bank. For asset managers, we have Aberdeen. We have the Nairobi Securities Exchange, and then we have other industries represented, like Mondelez, you know, like snacks, and Kofra, like the CNA clothing. So it really spans the gamut. But what they have in common is they all have a global footprint, and they all need to do cross-border payments. And so we are actually kind of dogfooding a lot with our governing council, beginning to convert these to using stable coins, and they're all very equally interested. So yeah, this is what we see. Of course, we have the financial institutions that are kind of leading also in that space. One trend that I noticed is that issuers now are increasingly financial institutions. We're seeing that you know, across jurisdictions. And then the existing issuers are becoming financial institutions by necessity because of the Genius Act as well. So it's all kind of converging.
Really insightful. Thank you for going into detail and giving us this point of view. And you know, my takeaway from this is whoever hasn't used it is at least planning to use it, right? And we're clearly seeing a benefit. Mm-hmm. Now, I want to play it to Aishwary. Aishwary, I don't want to pitch you guys against each other, but Hedera was originally for large institutions. You guys really were born out of the developer need of faster transactions and building something better. But also you start to now engage with the wider audience that includes large institutions. I'd love to get a little bit of a point of view from your end, from Polygon, on the global perspective, particularly how you see it with earlier stage companies, and then also provide an institutional point of view before we play it to Jonathan for a local point of view.
Yeah, I mean, so if you think about it, when you talk about money, right? And one of the very fundamental thoughts about money is money has to be neutral, right? You cannot kind of color money into something. And like we have seen that from the days of Visa. Where if you look at like when Visa was made, like, and initially it was a part of a bank, and then like everyone was like, if I partner with you, the problem is all my data will go to you. So that has been like a very big fundamental thing that like once Visa came out, became an independent entity, and like everyone then onboarded into it because they were like, okay, now this is not a part of a bank, this is a consortium, or this is a number of banks which are working on it. And that has been like a somewhat similar thesis for us as well, because ultimately what happens is when you go out and look at these fintechs, a lot of these fintechs want to go out and build their own blockchains. They want to go out and have their own money stack. The problem happens when you effectively go out and start doing that on your own. Like you've seen a lot of these financial institutions go out and launch. And like often what I have seen is because we talk to a lot of these financial institutions and banks and like fintechs, the biggest thing that they say is like, oh, I don't want to go out and work with that tech stack. There's no problem with the tech stack. The problem is like once they start seeing that, okay, like why should I go out and do work with you? Because in some way or capacity, you are my competitor. So I'm just fueling you as a competitor. And that is like one big thing that we saw is a very big gap in the market, where like a lot of people like are saying, okay, we want to work with this, we want to work with them. Where what we said is like, and that's why like a lot of blockchains, if you look today, they're launching their own stable coins. And why we have been like, whoa, we don't want to do that. Because the moment we do that, entirely what happens is we get into that same thought process. Okay, it's Polygon's money. Why do I need it on some other blockchain? So that is where like I think where we are focusing towards, okay, whoever wants to move money, what we need to build is the tooling that all that movement can happen. Like very simply put, like an example is, like I kind of deploy a lot of capital into multiple stable coins because we grow them on the chain. And like one of the things that I've seen is like just going from one chain to another, and like even the same stable coins don't have liquidity on other chains. So what we need to do is we need to build that kind of infrastructure that essentially can go out and help all this to move. We don't care like from a perspective of like who is moving it, as long as we can provide the services. Like you use Uniswap today. Like Uniswap is a protocol like for everyone is like you're swapping one token to another. The problem is like I used to work at American Express, and like on a daily basis we used to move like $6 billion. And now imagine American Express starting to accept 50 different stable coins. But at the end of the day, they don't want to hold 50. They want to hold one single stable coin, maybe their own, right? And then you start swapping that into your own stable coin. At the end of the day, you'll realize that Amex just on slippages has lost like $2 million. Now, does Amex want to do that? Hell no. That current cost is like, what? 50, maximum, I think, the way we used to move it, like every day it used to cost us somewhere around $10,000. So 10,000 to 2 million. Did we actually bring in efficiency? So that is where we are playing a role. Okay, we need to build products. We need to kind of go out and create those products which essentially can go out and foster these developments rather than becoming someone who is doing that development. So this is where like as Polygon, we've kind of moved from just only focusing towards developers, getting into the enterprises, understanding what they want, and like let them do it on the chain rather than you going out and saying, okay, we will do it for you. So that is how we are seeing the change.
And you're seeing that uptake by the larger players?
A lot of them. Like I think yesterday I was just like completing an RFI from a very big bank. They want to just
you want to tell us who?
No, that I can't. But like they
you can't blame me for asking.
Yeah, of course. I mean, what they are saying is like we want to launch our chain. We are a bank. We are a global bank. We have all the currencies. We will bring our currencies on chain, and we will create that entire FX market on the blockchain itself. So how can you help us? So effectively, and this is a very big trend that I'm seeing. Like in the last 1 month, I've talked to, I think, 3 of the top 10 banks, and all of them are like somewhat similar. So they are all going from the same thought process. They're like, yeah, stablecoins was amazing. Stablecoins will become a pathway, but they will not be the means to an end. There will be a lot of other like bank deposits and other things that will start developing, which would kind of become like their own gateways. And then some of these stablecoins will play an interoperable role between these because these brands don't want to talk to each other. So that is how like I'm seeing these companies coming in and like evolving now.
Just one last follow-up question. Do you think we're going to live in a world with 1,000 stable coins at some point? Do you think it'll all consolidate?
I think last week only I wrote this in FinTech Times. I said there'll be 100,000 stable coins. And the reason for that is it's not that they all will succeed. The reason is because everyone sees an economy of their own. Like if you look at an app in like Abu Dhabi or here, like let's look at Noon, right? Why would Noon want to go out and have a stable coin which is not issued by them? Because they can actually go out and enjoy the mechanics or the commercials behind it. So a lot of them will build, and I think a lot of them are building. Like we're talking to so many people, and effectively they've all built to it. So there will be a lot of that. Yes, what will happen is like 4 5 years later, everyone will realize this is not like this is much more difficult than we thought, and then they will all consolidate. But like right now, I think we are in a super cycle where tons of them are going to come out even more.
Cool, great insights. Jonathan, you're our local player over here, and we keep hearing about the UAE. So I'm quite happy. So Saqr means falcon, and Abu Dhabi has recently announced itself as the falcon economy. So I have an economy to my name. They've recently announced themselves as the capital of capital, right? We're hearing that everyone and their uncle is moving over here. What are you seeing on the ground? I know you have some real partnership. Maybe you can tell us about, one is your local point of view, and how do you see local entities? Are they really a bit more forward thinking than others?
Yeah, I think the local adoption and the local frameworks that support this adoption have been unprecedented in MENA and in particular in the UAE. You look at the Central Bank of the UAE, they announced this year the PTSR regulation, Payment Token Service regulation, to allow for the adoption, supervision, and regulation of stablecoin payment activity. Obviously, you mentioned the Genius Act earlier. You've seen that sort of global adoption of stablecoin regulation that supports these global money movements. And you're seeing more of that, market by market, but there's still local market nuance. So, to be able to on and off ramp stablecoins into local currencies for settlement, you might need a broker-dealer license locally. There's VARA that allows OTC transactions, regulated OTC players. Then you have traditional payment companies that might get a CBUAE license for the last mile fiat settlement. And we're seeing a combination of that under the lens of CBUAE regulations to support the adoption of these use cases. But what we're seeing is C2C remittances. The UAE is one of the largest, I think, top 3 global remittance corridors.
What's C2C?
Customer to customer. So if you're a migrant worker, blue-collar worker, remitting funds or sending your money back to your home country, you're normally faced with 5 to 7 days settlement times, between 5 and 7% in fees. And where we're seeing stablecoin efficiencies really disrupt these industries is by promoting instant settlement, under 1% in transaction fees. And, from a KYC AML perspective as well, you've got the immutability of the blockchain. So you can really trace the sender, the receiver, the full life cycle of a payment. And this is where Fuze is providing the licensing and the infrastructure to work with super apps, fintechs, even banks to provide them the tools to allow these efficiencies to develop, where the end consumer benefits. The B2B use cases as well, using stablecoin brings down your margin and FX cost. Your sort of treasury management, your pre-funding requirements are less when you're sending instantly the sending of value. So there's just a huge amount of support and adoption for stablecoin incorporation into your traditional financial services. And, I can take one example of a local fintech who supports the remittance of, you've got dirham to INR, to Indian rupee. This accounts for nearly 22 billion in annual volume, payment volume, and growing. So again, there's just huge scale for this from the UAE into India, Pakistan, the Philippines, where both the fintechs providing the service, but then the end customers benefit from the economies of scale and the efficiencies on speed of transfer, cost, and the transparency of the entire life cycle. So this is the sort of areas we're building into.
That's very interesting. I'd love for you to name, like, who are the clients that are really adopting it? I mean, obviously the publicly available one. Maybe Aishwary by the end of it will tell us who the RFI
I'm just trying
is
to think. You know, Botim,
All right.
large
Okay.
fintech, where we're sort of supporting them with a lot of those remittance corridors. And then you're working with local partners as well in the currencies for that last mile fiat settlement. So, you know, in the Philippines, there's like Gcash and other fintechs like that. So it's the ecosystem's building, but we're still only scratching the surface. I mean, I think the Swift report said there's $5 to $7 trillion of money transferred daily. Stablecoin is only at around 30 billion daily volume, so it's less than 1%. So the enormity of what's ahead and the scale is huge. And then, you know, stepping back from a global lens, I think 2020 now the market cap of stablecoins is 300 billion. With the growth and adoption, I saw McKinsey reported that it could reach 2 trillion by the end of 2028. So we're only at the start this year. You've seen crypto in a way, or digital assets move from a speculative asset or use case historically to now one of real world utility. And everyone talks about TradFi and DeFi and bridging Web 2 and Web 3 and stable coins and PayFi. This is where we're seeing that come into fruition. And it's real world use cases and adoption that are disrupting legacy financial infrastructure. And it's going to be a huge new paradigm shift for global payments and traditional finance. And yeah, it's exciting to be a part of that. And as I've said at the start, the UAE is at the forefront of that in terms of its central bank regulation, the local VASP regulation, and the local banking support, because it still begins and ends with fiat. So stablecoin's a bit of a sandwich at the moment, but I think you referenced that in terms of the amount of stablecoins that might come to the fore. We'll see this more sort of paradigm shift really materialize when you're not ending and starting in fiat. You're holding your assets on chain and you're settling and keeping your assets in your wallet on chain. That's where we're going.
Right. So I was just checking the time. So we spent the last 20 minutes hearing how this is the bee's knees, how this is the best thing in the world, how this is technologically there, how large entities have adopting it. But at the same time, it seems that adoption is at, what's the number you quoted, 3%? 8%?
For corporates, at least the ones that were surveyed was about 8%.
Yeah.
It's still early.
And mind you, I have my own answers to it, but you know, starting again with Sabrina, why is it that a technology that is so powerful, so beneficial, seems to be that, you know, we have three experts, three very large, I mean, between you guys, a couple of $1 billion, right, growing behind this, implementing time, effort, rails. So why is this not happening?
I think there's still an infrastructure gap to fill in, right? Whereas the availability to the average mortal is not there yet, right? Is it in your banking app? No, it's not. Is it in the corporate?
Mine, actually, believe it or not.
Okay,
yeah.
so maybe it is getting there, right? But in terms of you look at the corporate payment technical stack, not quite there yet. It's not there by default, right? But it's getting there. So give it a couple years. I think it's going to be everywhere. There are also when it comes to banking software, there are still some gaps to fill in. Your ISO 2022, your PAX messaging, all that the boring middleware and needs to be built. And we work with companies that are building it, and the compliance burden, is right now getting figured out.
Right.
So yeah.
So it's a tech compliance thing, Aishwary?
I think it's more education. So one of the biggest challenges that we are seeing is when we actually go. So again, without naming these companies, so one of the biggest PSPs of the world, When we actually went to talk to them about stable coins, they had no idea about stable coins. And this is the likes of the companies that are moving the money for the likes of Meta and all these other like big names. So the problem first is basically a lack of kind of having that understanding, and also the speed at which these enterprises move. So one of the things that we did actually, and which worked really well with one of these enterprises, was when we went to give them like a whole day presentation and their management was there, instead of starting about what is stablecoin, the first slide that we had was all the customers of theirs who were testing stablecoins. And we pasted all those news clippings into like that one slide. And believe we had a meeting for like 3 hours, which was booked, and it was a 90-page slide. That one slide actually took 2.5 hours.
I'm not surprised.
And why? Because I put all their major clients and they were all testing stable coins. This was their imminent threat that they saw. And like they were like, okay, what should we do next? And they were planning to do something late 2026. Their pilot is coming Q1 like in January actually now. So
Nice.
this is like where the biggest challenge is. Like one, a lack of understanding. The second thing is like you don't have that many people who understand the on-chain and the like the you can say the way like Web 2 and the Web 3 payments world. So a lot of people are like, okay, so I'll give you like a very fundamental problem today. Like when you move money on-chain, apart from the slippage, like you all like when you go into like there is a very big debate on Twitter. I don't know if you saw it about non-USD stable coins, and everyone is like non-USD stable coins will not survive. But the problem is like people are not looking at why on-chain they are not being able to come in, and that has been because like I'll give you my example. I deployed like last week around $500,000 in Singapore dollars and $500,000 in USD, and I created a pool on Uniswap. Forget like slippage, forget everything else. The prices move against each other, right? So my the limit that I set in that pool went out of limit, and there's an arbitrage bot that came in and swiped entire 500K. At the end of the day, when I closed the pool, I was hit by $3,500 of slippage, and I made $80 in fees. Nobody wants to do that, right? So you have to fundamentally see the problem. So I think we are designing one of those solutions with one of these like old DeFi platforms on how you can actually go out and solve for it. So a lot of these things, like we think like the enterprises are not ready. I think like a lot of Web3 tech that we are selling them is not ready. And that is where fundamentally we have to work on. And this is not like the scalability is not there and all those things are not there. It is more like the designs principles of like a lot of Web3 protocols have to modify themselves to actually be able to go out and like serve for all these people. Like I still cannot go back to Amex and tell them, why don't you move like 100 million daily on Polygon? So that is the problem.
Interesting. So it's a thing around education and the way we engage. Jonathan, why hasn't this been adopted globally just yet? Or you know what? You be the local guy. Give us the local.
No, I mean, I think it's been. I'm trying to think of a real example that we've faced that I can think of. Payments. You're sending money from A to B. It's going to be cross-border. The lack of global standardized regulatory frameworks is definitely an issue for mass adoption, because different local frameworks have different requirements. So, for example, MiCA in Europe, it doesn't allow the use of USDT. It's not an eligible token. So in MENA into Asia, the main stablecoin used is Tether. So if I want to make a payment in stablecoin and my preferred token is Tether, I can't send it to the beneficiary in Europe. There needs to be a bridge in between to swap Tether into Circle and then have the local currency off-ramp. Yeah. So different regimes have different frameworks. You also have regulatory constraints. So travel rule. Locally, VARA requires travel rule in all of our transactions. Travel rule being have you verified as the regulated counterparty, who the owner of that wallet is, who the sender of that crypto is. In other markets and jurisdictions, you have different interpretations of travel rule. You have sometimes they don't even adopt it. They don't use it. So I think they call that the sunrise rule in terms of the sort of the compliance constraints. So that creates difficulty in completing payments on chain because there's that regulatory arm across different frameworks. So I think with more broad standardization, with more adoption, you'll have more of that global hegemony of regulatory approval. But that's a use case example of making a payment on chain. And
right. So we've heard about the rails and the infrastructure. We've heard about the adoption point of view. I'm just asking here, and I'm supposed to get you guys speaking. Could it be that no one's adopting it because they're thinking that they're going out of business, similar to what your client has?
Yeah, I mean, that is like a very big and a real threat, actually. Like, a lot of them are like, so I'll give you, like, I have so many examples, sorry. But like, I think I was talking to one of the banks in India, and like I told them that using stable coins, they can save so much. And they were like, why are you like coming after my business? Right. Like what? They're like, so one of my friend like is like a very like a VP wealth manager in like one of these banks, and like I will like he constantly sends me Aishwary, like he just like between friends he likes to brag how much money he made on any day sending money, and he like often like sends me these messages. He's like, bro, I made like $3,000 or $5,000 sending $50,000 to Singapore from India, and I'm like, what? So he keeps sending me those texts. So the bigger problem, so someone has to look at it from a long-term horizon, to be honest. Why? Because today, if every bank is on board with the same utility, like they're making money in cross-border payment, if one bank sees that as a long-term vision and says, okay, what if we start reducing that cost? What would happen is, yes, they will make less money on the current volume. But what would happen is, as a result, there is a lot of volume that will come out from other banks and will start happening from them. For them to actually be able to kind of go out and like get that money back in, but that cannot be like, okay, in the flip of a switch, which is like you lost money, but that tomorrow all that money comes back. So someone has to take that long-term view. Contrary to that, like the other thing is like if they are not taking it, someone from the blockchain world has to do it, and so it's either or, like someone has to do it, both of them have to do it, but someone needs to do that.
Was there something you wanted to add here?
Yeah, sure. I mean, I think it's you get back to the old conundrum. Like, if you don't disrupt your own business, somebody else is gonna come out for your lunch, right? And I think a number of financial institutions are actually seeing that. And those who run an FX business, they have the chance to lower their operational costs. Maybe they can lower their fees too and gain market share, but still, like they'll still have a good margin. So that's. And in some cases, the clients don't necessarily care so much about the economics. They care about getting their funds right away, more than paying less in fees. So that in itself has a lot of value. And in corridors that aren't very well optimized, like maybe LATAM to Africa, the latency is very long. It's several days, and being able to get the funds almost within the same day or almost instantly, that has value in itself. So that is one problem that stablecoins can solve.
Yeah, I think I was just going to add that if 2024 into 2025 was a proof of concept kind of stage of adoption, I feel now at the end of 2025, it's no longer a debate as to whether this is a paradigm shift or whether this use case would work for mass adoption. It's now at a point of operationalizing and scale. And it's just going to be an eruption of adoption in the next few years. And I think you've already seen global M&A activity showing that. You've seen direct investments from the likes of Visa into stablecoin payment companies like BVNK. You've seen global multinational companies like Stripe make acquisitions into stablecoin like Bridge at the start of the year. And these aren't small acquisitions. I think Bridge was about like $2 billion. So I think there's an element of we're now in operationalizing and scalability, and it's not so much a case if you don't do it, you're going to get left behind, but you're already seeing major players buy into this technology, buy into this use case. And just as fintech was a threat to finance 20, 30 years ago, I think stablecoin or digital assets, what may have been perceived as a threat to traditional finance, I think you'll just see the same sort of merging and convergence of new tech into the old legacy systems, and there'll be a huge eruption now, but like you said, and then a sort of maybe a consolidation as well. But it's already happening. You're already seeing people getting on board. I mean, you've seen some U-turns in the press as well. You mentioned JP Morgan earlier, like Jamie Dimon saying the only use case for crypto was sort of money laundering, and now they're doing tokenized deposits and building their own stable coins. So it's the shift is already there, and we're seeing big players change their tune. So I think you'll see that merger happening in the next few years more and more.
Right. So we clearly believe that there's a paradigm shift. I think. Do you believe that payments and Bitcoin and digital assets are creating a paradigm shift? Right. Okay. You don't believe that. You do? All right. Okay. Perfect. With that, when we say paradigm shift, that means something. It's not just a cool buzzword. It means we're moving away from what we understand today, and we're moving to something completely different. So today, well, I'm not a good example because I've already adopted the paradigm shift. My money isn't in banks anymore. My assets are not in any way that I can't move quickly. But I'm wondering now, and this is a question to each and every one of you. With this paradigm shift that we're witnessing, fast forward into the future, will there be banks as we know them?
Well, I think very much so, because digital assets are increasingly regulated, right? So you take the Genius Act. You ideally you don't want to have a issuance cap. You need to have at least a banking charter. Central banks are, across jurisdictions are really monitoring this topic very closely. And in the countries where there is no framework yet, they are really taking notes and looking to advance the framework. So at least you need some sort of a license in a lot of jurisdictions. I think it makes sense for banks to do issuance because they can manage the reserves directly, as opposed to a fintech, relying on another bank, and that adds operational risk. So central banks are more comfortable with bank-issued stablecoins because banks already are operating within a very strict framework. So I think it's a matter of banks which ones are going to be chosen, or which one's going to have the capability to issue versus the ones that are just maybe going to adopt other stablecoins. So I think just watching this interplay between regulators and the financial institutions is going to be very important. There is definitely a role for institutions to play, and I see it really increasing over the past couple of years, where it's stable coins is not just the area of fintechs anymore. And as you mentioned earlier, there's going to be a mix between stable coins and tokenized deposits. Right. Because tokenized deposits have a different business model that may be more advantageous to banks as well. But the requirements for technologically speaking are they're more stringent when it's a bank that's issuing, because they have whole compliance teams, and so the bar is very high. So. For example, they will like a permission network because, for example, you look at the BIS compliance, you have two groups, and if you are on a permission network, you qualify for a lower capital requirement, so lower risk rating. So that's one thing. For things like granular controls. Typically, we work with banks very well because Hedera's token issuance framework allows for whitelisting. So we have KYC flag. If you can whitelist the account, then it can interact with the token. If you do not whitelist the account, it it cannot, right? And so things like freezing an account, wiping a balance, so you could do all that on Hedera. Your average, like, I don't know, some blockchains may have that, but most of them just, if it's in an account, it could go anywhere, right? If it's a fraudulent account, well, you're out of luck, but you don't have that control. But,
right.
So that's also something that I would say the compliance teams, they like to see these kinds of really high granular control that may not be so popular with maybe the more crypto natives, but if you're an issuer, you want to have that type of feature. So
Sabrina, I'm not surprised by your response that institutions will live. I mean, I'm glad you're here to, in many ways, represent those institutions. I'd love to hear from the other panelists. I used to say in 2015, one-liners on stage that I used to say, banks need to blockchain or die. Do you really think we're on the way there? Or are you more with Sabrina, where she says, you know what, institutions will always exist and they'll always find a place to exist? Jonathan. Go ahead.
So I think like the two changes. One, basically, the role of banks is changing.
Right.
And why is that changing is something that is very simple to understand. Like when you look at the money that is flowing from the banks, the fundamental way of how banks make money is they're able to kind of go out and accumulate capital at a lower interest rate, which is called as CASA. And then effectively against that, what they're able to go out and do is they're able to go out and lend it out, against which they generate revenue. Now, the challenge which is happening because of these stable coins is like when you hold the same dollar as a stable coin, you're generating more yields as compared to how you will generate that yield within the bank. Because that is happening, what is happening is a lot of this CASA capital, which is like low interest capital, is actually exiting bank. This has two challenges. One challenge is like all that low interest capital is going. That means you need to figure out a way to get your capital cost is higher. And the second thing is because this capital is leaving, because ultimately what happens is when you buy a stable coin, most of that money is going to the treasury. So that is not staying in the banking system, which means your credit creation goes down. And because of these two things, essentially what happens is banks have to kind of look at it and like see how to kind of go out and solve for it. And that's where like this whole tokenized deposit infrastructure came into the picture, because in a tokenized deposit infrastructure, you're kind of not letting that capital leave the bank because the capital is still sitting with the bank. So this is where you fundamentally change the way the bank used to operate today versus like tomorrow. And the second thing that is happening is a lot of that custody service, which is there because you ultimately need someone to actually go out and have those custodies. And like, honestly, like you look at one side where everyone wants to own their own assets, but the other side you have to also look at is whether their assets in their own hand without a regulation are good for them. Very simply put, like as an example is like I met someone last week who was like, like I put all my capital into crypto and I took money from my mom and put it on crypto and I lost it last week. And I was feeling sorry about it, but then he said I lost it because I was at 5x leverage.
Right.
And I was like, sorry, bro. I don't feel sorry.
Right.
I don't feel sad about you.
Yeah.
I feel sorry about you. And this is like where the thing is, like you cannot just go out and say like everyone is okay to hold their own assets because they know what the right decision from their asset is. So that is where like I think fundamentally these banks and the role of these banks will always be there, and they will kind of go out and do that. In fact, like a lot of small banks. So if you look at the regulations in US, the way when you go out and you increase your number of deposits in a bank, you effectively have to also increase the capital that you have put in the bank itself. Is usually, I think, 1:10. With stable coins, that is not there, because with stable coins, what you can actually go out and do after the Genius Act is you can always have, you don't need to have like that 10% capital requirement, which means a lot of those small banks which are stuck forever because they cannot, after 5 billion, 10 billion, they cannot go out and arrange capital. They are stuck. And those are the guys which right now, because I'm seeing a lot of these smaller banks now either coming
rising
rising, and they're either like, okay, we want to get acquired because bigger companies can now take us bigger because they can do it.
Right.
So that is where the change is happening.
Interesting. Jonathan, will large institutions, as we know it, not just banks, survive this paradigm shift we're living?
Yeah, I think they will, because they're already adopting the technology. I mean, even locally, we've seen 2 dirham-backed stablecoins being issued by banks.
Right.
AE coin by Al Mariah Bank, and then Zan just announced their dirham stablecoin. So banks are here to make money. They see the opportunity to do so by getting on board with these trends. So I think, but your point, I come back to proof of reserve, lessons from the past. You know, you look at FTX collapse and other sort of seismic events in crypto's history. These are the lessons of the past that now regulations and centralized sort of controls are, you know, if you want to launch or issue a stablecoin, you need to have smart contract auditability. You need to make sure that the underlying tech works. You need to make sure that it has adequate proof of reserves. The regulation is there for customer protection. It's not there to ruin the evangelism of crypto adoption. It's there to protect the customer. And to answer in a way your question, it's like, if I can send money 5% cheaper using crypto fintech A, I'm going to use them. I'm not going to stay with the bank. So it's blockchain or die, like you said. But at the same time, I can do it cheaper and quicker. But I still want to make sure that my assets are protected and that I'm as a consumer protected. So that's where those, you know, banks and central banks and more sort of legacy systems will still have a role to play for consumer protection.
I want to be the utopian amongst you and say, you know, we are going to usher in a new world with this amazing technology. I'm looking at an audience, and you've been a very captivated audience. Although I saw someone nod off, I'm not looking at you. But I'd wanted to check. Do you have any questions? Because apparently time is up. All right, so put your hands together for this expert panel. Thank you very much, and enjoy your day, everyone.